Everest Counter is a stock that's up and about in today's trading session on very, very large volumes. The read-through is that, if CNG cars are going to be sold more and they have a direct exposure out there, then their business could do well. That's Everest Counter is what I'm talking about. Mayuresh Joshi, Head Equity Research at William O'Neill joins us on the show. Mayuresh, I'm not sure whether you track this one, but the street clearly believes that, there is something in it for this company. In the past, though, the promoter entity has disappointed quite a few times. Your view on the stock?
Afternoon, Nigel. Not an active coverage, but I do track it personally. So I think in that context, with the entire perspective on what Sonal just mentioned on the gas pricing ecosystem in India itself, EKC, Everest Canto, I think is very well positioned to probably capture that entire demand. I think the entire CNG ecosystem demand in terms of more vehicles expected on road in the next few years, transition happening both from a BS6 perspective, as well various government initiatives, including scrappage taken into account. The expectation is that from 3.5 odd million, almost 3 times over the next 5 to 6 years. Having said that, the kind of capacity plans that EKC have, the latest release does indicate that they probably want to expand their capacity on an overall basis from 0.9 million units to almost 1.8 million units to suffice the gas requirements itself. And that is probably getting exhibited through their financials as well. So the revenue that they posted of almost 1,700 odd crores in the past financial year, with a reasonable amount of margins on the consolidated basis, and even a pre-ROC or even the post-tax ROC level of almost 36-37 odd percent is a very encouraging sign. So I think with all these elements taken into place, the expectations in terms of more consumption expected to drive cylinder volume growth, both on the car side, the industrial usage side, and now getting into the hydrogen part of the business, which is expected to grow exponentially in the next few years. So will the momentum continue? Possibly, yes, with all the triggers and tailwinds.
Okay, Mayuresh, hi, welcome to the show. It's very quiet for the market today, but are there 4 or 5 stocks that you're looking to buy now after the kind of, of course, in the last 1 or 2 weeks, the market has risen, but in general, post the dip that we've seen in the last 6 months, anything that you're picking up?
Afternoon, Sonia. So capital goods has always been on our radar for 2 reasons. One, the entire perspective in terms of how earnings will play out significantly better for the entire space as a whole. So I think capital goods as a space can continue doing well. We've already seen testimony in the form of better orders coming through. The companies are executing well across the value chain, and therefore the margin performance of most companies within the spaces should hold out in the next few quarters as well. And with that, I think significant operating leverage will probably mean that better ROEs and ROCs, along with ROICs, because the kind of capex that they're putting in, every incremental capex is expected to probably earn a lot more in terms of EBITDA over the next few years as more and more orders fall into their kitty with an election year coming through. So stocks like L&T, ABB, Siemens from this space obviously stay on our radar. As an extension to this space, Sonia, infrastructure also remains a big hot theme in terms of how earnings are expected to play out. And a few of the companies that I mentioned a few weeks consistently on your show have been companies like Nagarjuna Construction. If they do correct some bid from these levels, I think they will have a reasonable amount of entry point. Very good order intake that they have, very good revenue visibility with the order book in excess of 50,000 crores. Margins expected to remain above that 10-11% band, and execution is expected to remain extremely satisfying as per the management in the next few quarters, which means that operating leverage will play out for companies like NCC, VATech, Wabak as well, which is one of significantly huge order. Working capital trays have come down to 90 odd, and therefore this space remains on focus as well. The third space will obviously, from an earnings perspective, also be some of these power utilities and a few of these cement players as well. Quarter on quarter, cement companies should report significantly better numbers with medium coke prices coming down significantly and freight costs remaining in the range. And therefore, the EBITDA per ton should show some signs of improvement. Whether there will be significant capacity additions with all the Adani turmoil that we probably see, might be just on the back foot at this point of time. Companies are trying to push through volumes to dealers at this juncture to probably gain market share. But to a large extent, I think the EBITDA performance for most cement players should be good. UltraTech probably remains on our focus list.
Mayuresh, you spoke about many of the sectors that you like. Power, utilities is one, few of the capital goods names. What about real estate? The numbers have been blockbuster. A couple of weeks back, it was DLF and the luxury housing sales. Today, you've got numbers from Godrej Properties, best ever, on track to hit more than 12,000 crore of sales. Shobha Developers numbers also look pretty good so far, the Q4 update. You're not convinced about the real estate momentum?
So to a certain extent, Rima, I think the updates have been pleasantly very good. If you look at Godrej's update as well, the kind of cash from operations or cash collections almost at 9,000 odd crores. The outlook that they've probably given 32,000 odd crores in terms of more launches expected and 10 million delivered in the last financial year. I think that emanates a lot of confidence in terms of a lot of cities that they operate out of in spite of the rising interest rate scenario. Same with Sobha to a large extent. Best quarterly performance as far as sales is concerned. The realization per square feet has been maintained quite well as well. And therefore, I think the demand that probably comes out for South-based real estate players, how the IT sector will probably hold up is a great driver for demand. So I think how the IT sector will perform over the next few quarters will determine the few trends in terms of South India real estate. But yes, selectively, I think some properties like DLF, which got sold out in a couple of days, have been outliers in the market. There are a few tax changes coming in as well for high-end real estate properties as well. But I think with the kind of momentum that Godrej has probably exhibited, probably a few momentum in a few stocks like Godrej can very well continue. But if this trend is to continue, Rima, I think a few of these ancillaries can also do well. So on our watch list again are a few ancillaries like KEI, which also becomes a proxy to these real estate players. Volume growth expected to be reasonable as per management. Input costs have started coming off, which means margins should get maintained for the company in the coming financial year. And a reasonable amount of orders on hand means that margin performance along with operating leverage should get.
Okay, well, we're just coming down to close, and it has been a very quiet day of consolidation for the market. The Nifty will go home with minor gains, not too much. But the Bank Nifty is the one that's under pressure. Mayuresh, the big Q, of course, as we move into the next couple of days will be the IT earnings. TCS on 12th, Infosys on 13th, and then, followed by the whole array of stocks in the IT space. Anything that you're looking to buy if, suppose there is a further dip or there is some weakness in earnings or FY24 guidance, anything that you look to lap up?
So on the O'Neill lens, Sonia, I think clearly out of the large cap names, HCL Tech surprisingly is holding up close to its pivot levels as we track it. I think 1150 becomes a very, very important pivot for HCL Tech. Again, the expectation largely is, as Rima carried out a beautiful piece, the top line growth in constant currency terms might be a little bit subdued for their exposures in BFSI, retail, manufacturing for the industry and HCL Tech in general as well. But generally, I think margin expansion should hold the key for a lot of companies within the segment as well. So I think within the large caps, HCL Tech is something which is very, very close to the pivot on the O'Neill lens. Within the mid cap universe, I think the two outperformers, KPIT and Sonata, have done exceedingly well. But again, they are late stage bases on the O'Neill lens. So we expect that if they correct a little bit more or a little bit more even from the current levels, I think valuations will become a little bit more sanguine and therefore entry points will become far more reasonable. So I think we'll wait for dips on mid-cap IT. HCL Tech probably is holding out on its pivot.
Mayuresh, thank you very much for joining in today. It's Wipro, which is having a pretty good up move, 2% higher now on Wipro. And Wipro, remember, has been the rank underperformer in the large cap IT pack, down 35% in the last 1 year. But thank you very much, Mayuresh, for joining in.